Hello, everyone. It's Lou Joseph from Remax Preferred Realty. Just coming to you today just to recap the market for November of 2020, also to recap the year 2020, how this year went along for real estate. And yeah, it was a very surprising year, to say the least. We had this pandemic that we were in, but real estate was moving along quite well, and there was quite a buyer frenzy in this market. And I'm just going to go over a few pointers here. Some of the pros and cons for the seller's market that we found ourselves in this year. So, seller's market, meaning that the sellers are in the position where people are looking to buy property, and there's a bidding war, there's a high demand for real estate, and there's a low supply. So the sellers are in control of this market, and when sellers are in control, the prices of real estate start to trend a lot higher, right? So we're going to go over the pros in this market. So we have the move up, you know, uh, consumers, the move up buyers. So you're looking at upsizing, and because of the market increase in prices, all of a sudden your home that was, say, worth 200,000 probably 7 years ago is now worth 350,000, and that gives you equity that you didn't have to go and earn. You didn't have to go out and earn income and then pay your taxes on that income, and then now you have this money set aside to buy a bigger house. This is money that came into equity in your primary residence that you wouldn't see if the price didn't go up, and now you can sell that property, say, for 350 now instead of 200, and now you can put in 5, 10, 15% down on the larger home, so you can leverage upwards. And with the low interest rates, that makes it attractive for the monthly expenses, right? You look at how much it costs to rent this property, how much it costs to carry it, and it's still, we're looking at, it's still better to buy it than to rent. Now we're looking at people who are looking at downsizing. So these would be um, retirees, somebody that's possibly in their late 50s, going into their 70s. They're looking to sell maybe possibly a luxury home. Say they sell a home that is 700 to $1 million, and then they move into a condo for 400,000, townhouse for 500,000. So there's that equity that increased in their larger home that they're taking with them when they downsize to use for retirement and vacations, whatever they want to do with that money, right? Um, Out of town buyers. So out of town buyers, everybody's looking for the out of town buyers for their properties, and what it is people from cities that where the prices, average prices are possibly 800 to approaching $1 million. People are selling their properties there, and they could possibly work remotely, so it doesn't matter where they live. So they'll buy a property where they can have a backyard instead of living in a condo. They can have larger square footage. They can have a double car garage, all for less, half the price of what they can get in their city. So that's very attractive for them to make that move. Also, retirees in those cities, that's also an attractive feature to sell high, come here, buy the same style house, same size for half price, and have money for retirement. Okay, so we also have the out of town buyer investors. So where they're from, the return on their investment is very low. So the cap rate over there might be, 3% or 2%, or they were used to banking on capital appreciation, say in the GTA area, and maybe the capital appreciation strength isn't there compared to the capital appreciation over here in Windsor over the last few years. So they're looking at how our rents are rising dramatically, and if they can get a property that's vacant, they can clean up, they can charge the premium rates for rent and have a higher return on investment than they would back home. Um, Refinancing is another pro of this market. So if your property that you bought 5 years ago is 250, now it's worth 500, you can borrow up to 80% loan to value on that property. So some people are looking for debt restructuring. They're going to take the money out of their house, their equity at 1.8% interest. So you're paying on that money, that debt, 1.8%. So you're paying under 2%, and your credit cards might be 18%. Your line of credits might be 7 to 10%. So it's good to just pay off those debts and then take on a debt that is lower in interest. So you're saving on the interest. Also, people are looking at the market and they're saying this is really in a really unaffordable market. We don't want to make a move. So what we're going to do, we're going to redo our bathroom and kitchen. We always wanted to do that. Now we can, and we can finance it very cheaply through our home. So that is one very attractive thing about this market is refinancing. And also people think they can get a better return. So if you're pulling $50,000 at 1.8% interest, maybe you can get 8% on that money, or 10 or 12%, depending on your experience on investing in real estate in the stock market or investing in a business. Those are the things that you can get higher interest, higher yield on money versus on the mortgage per se. So the cons, there's definitely cons in the market. And the first con I would like to point out is the first time buyers. So people just entering into real estate, this is a rough time for them. People that already purchased and selling and buying another property, that makes a little bit more sense, right? But somebody that is entering the market for a first time, mostly millennials, they're buying properties in Walkerville now for $350,000 when they were just half off, not too far ago, right? They're taking on a little higher debt load. They're needing some help from parents possibly. This is probably a stressful time for them, but they want to enter the market because the past history is that the market has been trending upwards. They want to get into the market just to secure their position in real estate. But it's definitely tough. It's getting to a point where first-time home buyers, in maybe the next few years, are going to need help. They're going to need some government assistance. There's already talk in the United States with the Joe Biden presidency that they're going to issue out some grants for first-time buyers to get into the market. So I think there's going to be some government assistance coming forward to keep this market propped up, right? But still, we are going to eventually get to a point where first-time buyers can no longer enter the market per se, and that makes it a little bit difficult for prices to continue to increase because the first-time buyers, they're basically the foundation of the market. If they lift upwards, the rest of the market lifts upwards with them. In this market, investment properties, you're seeing a lot lower returns than maybe 10 years ago. So a cap rate, maybe 10 years ago, you might have gotten a 6 to 8% cap rate on your multifamily. Now it's looking like 3 to 5%. The lower the cap rate, the more you're banking on capital appreciation of the property, of the value going up every year, and also you are banking on the tenants leaving and then you raising the rents. But the reality is that tenants, I don't think they want to leave these properties because they got locked in at low rents, and you cannot just go and increase the rents on them. There's regulations for that. So what happens is you have investors patiently waiting to overturn tenants to then put it up. So if they're paying $1,300 a month, you're waiting for them to leave so you could charge $1,800, $1,900 a month. And they may not leave. They might make a big deal to stay, because why would they want to leave if rent outside is going to be a lot higher? So that is, we're getting to we're getting to a threshold there, and how high rents can get. We got to see, because I don't see salaries and income rising to the extent of rents. So that's where there's a dynamic where eventually rents have to cap out somewhere. Um, so the investments are banking on the turnover tenants and also capital appreciation. Over leveraging. If somebody in a seller's market is looking to just gobble up all kinds of real estate and say like 5 to 10 properties, and they're all loan to value, 80% loan to value on all of them. If we experience an increase in vacancy rates, if we have an increase in unemployment, if we have an increase in the interest rates within the next 5 years or so, these properties might be very hard to hold on to and manage, as well as all the deficiencies that you'll have to fix along the way. New roof, a furnace, an air conditioner. If you're over leveraged going into the seller's market like this, I think it's a very definitely dangerous time. I don't say don't buy any income property at all, but if you're doing it in a hazardous way by taking on too much debt, this can be a con to the seller's market in particular. The last point I'm going to talk about is interest rates. Interest rates are historically low. Can they stay like this for 10 to 20 years? I don't think so. I think probably within the next 5 years we'll see a difference in interest rates. So we have to be careful and anticipate higher rates in the future. So we got to make sure that our primary residence or investment properties, we have our checks and balances in accordance to the possibility of a higher interest rate. So I'm going to go over today basically how November statistics went along, as well as the year. And I hope it's very informative to you to watch this video. If you have any questions at all, feel free to reach out to me anytime. I'm on social media, Facebook and Instagram, and I'm also on YouTube here, but you can definitely call me on my cell phone, 519-817-0887. Okay, we'll get into the numbers. Thank you. Windsor-Essex County Association of Realtors website. This is just public information. Anybody can go on this website to take a look. Now we're going to go over the month of November, and first chart we're looking at here is the available listings. So the market activity. So for November this year, we were up in listings almost 10% compared to November of last year, which is good news. Getting some more inventory on the market. Now, if we look at 2020 from year to date, we are actually still down in listings 8.2%. So the reason for this negative listing year to date is if we look at the months of this year. So we had increased inventory coming in February, March, and possibly anticipated for April, but we had this lockdown for our pandemic, and we've seen these months suffer as far as listings. That makes sense. Sellers are not interested in having a lot of people through their home during an uncertain time. We didn't know exactly how extreme this virus would have been and the pandemic lockdown would have been. So sellers just opted out of the market. But we had buyers still in the market looking for opportunities, which they found in those months. Now, when we got out of lockdown, we saw that prices, our listings, started to increase again. And even in September, we've had more listings than the previous months, and even in November as well. But these 2 months really messed up the year-to-date numbers and has also kept us in a seller's market. Now we look at sales. Sales in November are up 6.3% versus last year. And again, same chart here. We saw dips in sales in April, May. But as we get into August, September, October, we see increases, even July, increases month over month. Year to date, actual sales are up, even ignoring the fact that we had the very low sales in April, May, we still are up almost 1% in sales year to date. Average price of November is almost 25% higher than it was November of last year. And if we look at the average price here, we look at 2019, we see average price peaked in April and then went sideways throughout the year. Whereas this year we've seen prices, the trough for this year was actually April, so it wasn't a peak. So they matched up April of 2019 and April 2020. The prices actually, average price matched up. But from there, you have the government stimulus with the CERB and the business loans that the government were giving out. So that stabilized everybody. Maybe people were, a few months away from not paying a mortgage. You have mortgage deference happening. So this is what kept the market stable and held it up. Now, when we came out of the lockdown, there was a big boom in sales and listings, and the prices also boomed upwards as well, up until July and even into September. But now we're getting into the winter months, so the average price is starting to decline slightly. Average price year to date. So average price year to date, we're actually up 21.5%. Again, we see the same kind of movement as far as prices, where they declined, in April, but then rebounded since then. And then we have median price. So median price is, a median and average, they're different, right? Average, you're just taking all the numbers and adding them up and dividing them out. Whereas median, we're looking at where most of the homes are being sold and what price in the median price range. So we're here at 384,000 for November. Year to date, we don't have too much data to go by here, but year to date, we have 379,000 for median price. Units sold every month, it seems to be the same. 420 to 550 is the most popular price range. So what you're getting in that price range, you have a lot of raised ranches selling in that price range at the moment. You got townhouses. You have older homes that have been renovated that have been selling that price range in areas like South Windsor, LaSalle, Tecumseh. We're seeing in the 300, the next most popular is 300, 360. So in that price range, we are actually seeing some of the older homes, say in East Windsor or Walkerville, South Walkerville, that have been updated. Maybe not so much in South Walkerville, but like say Old Walkerville, you have a 2-story that's been updated, new kitchen, new bath. You're going to see that selling in the 350 range. You're going to see homes even in the West Windsor are now selling in that price range. For that probably more of the upper end of the price range for that area. And but we still see a lot of people that are pre-approved up to 300,000, and there's a lot of competition in the 300,000 and under, because there's not many listings, not many properties that are going to sell in that price range as we see here. We have a lot of fixer-uppers selling in this price range now, depending what areas. We have properties downtown, Ford City, West Windsor, that are selling this price range. So a lot of the income properties too, single-family income properties are selling that price range. And year to date, again, it's almost identical to the month chart here. So we see which price range are the most popular. Okay, so yeah, this is just a snapshot of the monthly, report here, and I hope you got some information out of this. And thanks for watching. Okay, this concludes our monthly report for the real estate market in Windsor-Essex County. If you have any questions or would like to reach out, you can definitely give me a call or email me anytime. My contact information is in the description below. It's been great. I hope you got some great information here, and we'll chat again soon. All right, take care.